Okay, good morning, everyone. We will get started here. Once again, I want to thank everyone for taking time out of their busy day and joining us here for this One America webinar. We have Jeremy from One America that is going to be our presenter here today, and he is going to cover some exciting, information here on this new fixed index annuity that we're able to illustrate here for you now. And I'm not going to take any of the thunder away from him, but we will be, we do ask for any questions that you may have. Just please chat them in there. And then at the end of the presentation, we will answer all the questions that we have there. So with that, Jeremy, I think I'm going to turn this on over to you and let you get started here.
Perfect, Chad. Thank you. Are you able to hand me controls? So there we go. Perfect. Right in time. And I will hit. Okay. Can you see my screen, Chad? It says it's showing now.
I can. Yep, I can. But it's. Can you make it a larger though? It looks like it's there.
I just got to hit that. There we go. Is that better?
Yep. I believe that's better.
Okay. Well, thank you everyone for taking time out of your day. We don't intend to have this take too long. It's basically an indexed annuity chassis. So for those of you, I would assume most folks on the call are familiar with the basics of index annuity. I mean, the general principle is protecting the downside risk, where obviously your clients can't lose anything when this one in particular is tied to the S&P 500. So, but it gives them some upside potential to get better growth than they would in, say, a fixed account. So we've basically combined that with the ability to have a story to tell that your clients can access any of the gain within this annuity tax-free, regardless of whether or not how large the cost basis or gain was. So we'll kind of get into the meat of it, but in all essence, it is truly just an index annuity as you know it, with two particular features that are already built into the contract and one optional feature you can add. And those two particular features, one is the fact that if it's funded with non-qualified dollars, all gains, again, it doesn't matter if this was an index annuity, prior, fixed, variable, when you bring that movie or that index annuity over, or that annuity over and put it into this index annuity care, all gains are tax-free for any qualifying type of care, including in-home. So there's one feature already built in. It's the only indexed annuity out there that is what we call Pension Protection Act compliant. And that is the tax law that allows for tax-free gains. So for those of you that are familiar with indexed annuities that have income riders, and maybe that income rider, if they put $100,000 in and it pays out 5% a year, so $5,000, but it doubles to $10,000 for care, that is completely different. It is not tax-free, and it will give a much lower care benefit. So this is going to be definitely geared and allow you to capture dollars that maybe income benefits, income riders, or tax deferral loan will not. The second feature, which we will review, is there's a bonus built into the contract. So if the client or clients, because you can write this on a joint scenario, were to need to file a claim and need care, we add a step-up amount, a bonus feature basically, for that pool of money for their care. So even if the indexing is growing or hasn't grown because the S&P was flat or negative, they will have a guaranteed step up for their care. And again, it's all tax-free. Those two features are already built into the contract, and those are the reason why this annuity could allow you to move those old annuities that a traditional income rider or just tax deferral loan may not. So as we're going through this call, if everybody on the phone line here can just think of your clients, especially your clients between the ages of 70 up through age 85, because we'll write this through age 85. Focus on those folks. Focus on the folks who maybe have higher guarantees than they can get right now. Focus on the folks who are not taking income off their annuity, because something like 84% of people with non-qualified annuities die with that annuity still in force. They don't want to take out the taxable gain first. So think about those folks. If names pop up, write down initials or names, and then call Shad and his team over at Premier and have one of these illustrations run. So this PowerPoint here, the first few pages, we're just going to kind of breeze through some of this. I really want to get to the meat of it and get you guys back to doing what you do best. So, just our story at One America. For those of you on the call that may not be familiar with us, we're an A+ AM Best rated company, 95 Comdex. That puts us in the top 7% of all U.S. insurers. As a matter of fact, when you look at Comdex rankings, which rates you against your peers based on your ratings overall, I think there's only 6 or 7 companies above us. So mid to large size company based out of Indianapolis, mutual company. So that's fared us very well throughout this market downturn. We were the first to create what we call an asset-based long-term care plan, meaning forget the old, pay as you go, use it or lose it, premium rate increase, car insurance types plans, because the vast majority of the public says no to that, or by the time they think about it, it's too late or it's too expensive. And then this whole history of premium rate increases over the last couple of years. What we're proposing is, hey, look, if you don't buy long-term care insurance, that's fine. But as a client, then that ultimately means that you are the one that's going to fund your care. And for you as the agent or the advisor, that could potentially disrupt the assets you have under your supervision as well. So what we're going to show you is how to simply reposition an asset, get some care leverage, get some care benefits, justify moving old dollars, again, that maybe traditional income benefits may not allow for if the client doesn't need income. So you have the ability to move the dollars and create a plan at the same time, put the client in a better place. But unlike a normal long-term care policy, if the client needs access to it while they're alive, it's still their asset. And if they die and never need care, only need a little bit, whatever's left and remains in that annuity would pass just like a normal annuity. So again, it's just like an annuity. It's got these added features. And then there's even an option to add a rider to extend benefits for as long as a lifetime, and that would just be a separate premium, and we'll talk about that, but I think a lot of you on the call may not even go down that road. The first two features that are already built in are a reason enough to have the conversation. So we're the first to create this type of concept. We're in our 26th year now, and we were the first to create a life chassis with LTC benefits, which has become quite popular in today's marketplace. We were the first to create a fixed annuity with an LTC component. And now we are the first and only company in today's market to have an indexed annuity, again, that is Pension Protection Act compliant and allows for tax-free LTC withdrawals. So we'll kind of go through indexed annuity care, but really, again, all it is it's based on the S&P 500. It's a very simple indexed annuity. There are not any crazy crediting methods. We had to make this very simple because, again, we have added features and benefits built into this contract that are not on any of your other index annuities that you're aware of at this point in time. So we have the option to have a base policy, which is the annuity itself, and then again an option to add a rider, and I'll give you a quick visual. Here's some of the specs on it. Unfortunately, because there is some underwriting risk on our end, and there is no exams, no doctor's records. Matter of fact, you can issue this thing with just 5 knockout questions on the app, or a phone interview if you're going to add the rider. But if you don't add a rider, it's just simple 5 knockout questions, that's it. But the point being, because there is some risk on our end, we can't just accept anybody in this thing. So, we have to limit it to age 85. It is a lump sum funding only, not a flexible premium. And again, the funding can be non-qualified or qualified, but the tax benefits only come into play if it's funded with non-qualified dollars. And it's a 9-year surrender. However, we do allow for 10% free withdrawals, like most of your annuities out there, which are typically 10 or 15%. So 10% free withdrawals after the first year if they need it for something other than care. If they need care, obviously we waive surrender, and if they die, of course, surrender is waived. So again, your focus, I think, demographic, not that we won't love to have this on folks, 60 years old, but I think the bulk of the business that we've seen in our annuities for sure, and I think where you guys might see this fit the most is your 70 to 85-year-old clients, because these are the clients that typically have gain in an annuity. They've held the annuity long enough to have some gain. They may be in a place where you can't really move the money at this point in time, but if you're able to bring this into play, they don't have that on their current annuity. It could be a reason to move it as long as they say, yeah, hey, I didn't know this existed. This would be my first plan for if my spouse or I got sick, right? And so that's the base annuity, and then we have the option to add a rider. So I'll give you a nice visual here, but the visual is going to look like this. So you have your annuity itself, which can, again, you can just offer the annuity itself. No phone call, nothing. Just 5 knockout questions on the app, and I'll show you those at the end of this, but it's basic stuff, like are you already in a wheelchair? Are you on oxygen? Can you not perform an activity of daily living? These types of things, okay? And then you have an option, if you want to go down that road, you can add a benefit to, so if they put $100,000 in, we can give them another bucket of 100 behind their money, a bucket of 200,000, so we're doubling their money behind it, or unlimited lifetime. And this is a rider that could either be charged out of the incoming 1035 premium or cash deposit. We see a lot of cash in this stuff. Or it could be a separate fixed annual premium that is guaranteed to never increase on the client and could be tax deductible, because that rider That's not going into the client's annuity balance. That is just covering pure LTC coverage. But I'll tell you what, let's stop there and let's start with just the base annuity. Because again, I think a lot of folks on this call could offer just the base annuity, and it has a lot of power on its own. And then you can get away with not even having to do a phone interview. If you have a client, and they're, you really get it, they get it, and they want to add that rider, then we can go down that road, and we'll take a look at that as the second portion of this call. So I mentioned that there's two features. There's the Pension Protection Act feature, which allows for, assuming this is funded with non-qualified dollars, all gains, including our step-up leverage amounts, right? All of that tax-free for any qualifying care, in-home, assisted living, hospice, nursing home. And remember, folks, if you have questions, there is an area on your box there to type it in. We'll address them all at the end. But the long-term care benefit balance, for those of you in the annuity world, think of this as your bonus amount, your step-up or your bonus, okay? This is something that's already built into the contract at no cost to your clients, okay? Now, are our caps and pars going to be as high as the highest that you find out there in the marketplace? No. For example, our annual point-to-point right now is paying 3.5, and I know there's plenty in the 4s and some as high as like 5 or so. So this is not a cap or par play, but remember, this wasn't necessarily money you were going to move for that purpose anyways. The sell is that you still, as the client, get to take advantage of the S&P, right, of any potential growth, but you have these other features built in that are not on any other index annuity or out there today. So, we kind of took from Peter to give to Paul. Peter was the cap, so we didn't want to come in and try to, get in a cap match with other carriers, because that's not our story, that's not our game. So we have caps, they'll be in the ballpark, but they won't be the highest. But again, we have this balance built in at no additional cost. So one could make the argument that the cost really is just that the caps and pars aren't going to be quite as high as what you might find out there. So here's how that works. I'm going to go through this with you guys. I don't necessarily think you'd need to go through this with your client, but when it comes time, let's say, females, she goes into this at 65 or 70, and let's say she's 70 and she needs care at age 85, so 15 years later, which is somewhere close to the average age of care anyways for a female these days. So what happens is we'll look at these two bonus columns, and we'll give her the better of the two. So the first column on the far right says adjusted net single premium. So let's think about this. Let's say that she put $150,000 into this annuity, and let's just say, we know this isn't popular, this isn't likely, but let's say for 15 years straight, the S&P 500 was flat or negative, okay? So there was, just like any other index annuity, her actual cash value, her accumulated value, would still be just $150,000, okay? Because she had no gain. She had the downside protection of the index annuity, but she had no gain, no step up, or, and she may have gained from the old annuity that came in, but I mean, she has not had any positive credit. So what we'll do is in that 15th year, we'll go down, we'll say she put $150,000 in this initially. We'll multiply that by 1.35. And you'll see here down in the middle of the screen on the right, lower middle, that comes out to $202,500. So even if the market never performed, the S&P never performed, she would still have $202,000 tax-free, including not only the leverage we gave her, but all the gain that came over from that existing annuity, assuming it was non-qualified dollars, for her care, okay? Or, again, remember I said we'll give her the better of two columns, or we'll give her her actual account value, which many of you on this call would probably, if we were betting, would probably bet with me when I would bet that she's had some growth in the contract in that 15 years. So let's say over the 15 years with her caps and her pars, right, whatever it is that you did, her participation rates, it grew from 150 to 224,476. We're going to multiply her actual account value by this feature. And again, whichever bucket is larger, she gets automatically. It's the benefit of having either column. So in this case, that would be higher. And so her actual pool 15 years later in this example would be $258,147. Again, all tax-free for any types of care. All right, and what we basically do is we'll spread that bucket amount over 24 months. In other words, it pays her own annuity value to her over 24 months. So we would take that $258,000 and change and divide it by 24, and that would be her monthly benefit. So if you think about it, if you have simply put, if you have 100,000, let's just say, in an income rider that's paying out 5,000 a year, and you add one of those LTC doublers, now you're giving her $10,000 a year. With us, if you take 100,000 right away and you just divide it by 24, we're giving her 4,166 a month. So if you multiply that, that's about just shy of 50,000 a year, and it's all tax-free. So hopefully you can see why this is so much more powerful than simply adding one of those doubling LTC benefits to an income rider. So very different play. But again, imagine all those people in their 70s and 80s that they don't have any idea that there's a way to get some care coverage with what an asset they have, get some tax benefits, and they just need to hear the story from you. So, you know, it gives you the reason, it protects them, and it protects your assets under management, especially when you consider you can make their benefits last lifetime if you so choose. So that's the basic annuity on its own. Here's what it actually looks like. We talked about the tax advantages. Here's a nice visual. We do have a client piece that gives this visual, but it shows you how that existing non-qual can come over, okay? And then here's basically your indexing. Again, for those of you on the call that are familiar with index annuities, this is going to be a walk in the park. So first and foremost, there is a fixed account. It's a 1% minimum guarantee. It's currently paying 1.2, and you could throw the client into 100% of the fixed account if you wanted to, if they just, you know, didn't want any indexing, okay? Then we have a point-to-point, annual point-to-point, and you either choose a cap or a participation rate. And then we have a monthly average with a cap or participation rate. Really basic stuff. You could do 20% into each strategy, including the fixed account. You could do 25% into each strategy and not do the fixed account. I mean, however you so choose, and each year you can reevaluate that and change that up, okay? I'm not going to go over too much caps and pars. Again, if you're learning an index annuities, that's not really the goal of today's call. Work with Chad and his team over at Premier if you're kind of need a ground up on how an index annuity works. But you know, ultimately, a cap rate, for example, if the S&P does 16% and your cap's 3.5, you would get the full 3.5. We do not have a spread on this. There's no internal charges. This is what you get. What you see is what you get. So on the opposite side of the token, if the S&P was negative 16, is down 16%, you wouldn't lose anything. Your floor is 0. So that's kind of the whole goal here. This is our current caps and pars, as you can see here. Again, nothing to celebrate here in terms of caps and pars, but remember, that's just the added bonus of the story that we have. That is, if you don't use it, you don't lose it, and you still have the opportunity to get some growth in the contract. The main goal here, folks, is, hey, let's reposition this, create a plan should you, God forbid, you or your spouse need care. But if not, it's your asset still, whether you pass that on or use that for something else, okay? So again, I mentioned this could be single or joint. What is really cool, and if you're doing something else right now, like a lot of people do on webinars, if I've lost you at any point, listen to this part because it is pretty important. You can have an individually owned annuity. So let's say it's a husband and a wife and it's her annuity. When you bring that money over to us via 1035, and we'll take a partial all day long, assuming the transfer company will allow for a partial. But the point being, when that annuity comes over, we can actually add the spouse, in this case her husband, for that care benefit. So they would each get, if their monthly benefit was $4,000 a month or $6,000 a month, they could each actually file claim and each pull that full $6,000 a month. They don't have to split it. They're just depleting their annuity twice as quickly. And then they would get into a rider if they had added it. So what I'm ultimately telling you is that you can cover 2 people under an individually owned annuity, assuming the other person is a spouse. And that spouse would be the primary beneficiary. So if the owner died, the spouse could continue this contract as is with everything the way that it was sold to them, right? Everything, the way that you position it, here's your monthly benefit, all that stays the same. So pretty darn cool. That's the base policy, and that's it. So if we go, and I'll pull up the knockout questions here. If you just write that policy as is, like we just discussed there, with those 2 features already built in, on Section B on the first page of the application, it's going to ask them 5 questions. And if they say yes to any of this, it's basically telling you don't move forward. You're not going to most likely get this contract. So, you know, take a look at these right here. It shouldn't be anything too shocking to most of you. This is the stuff that, you know, if we were accepting this, we'd be basically buying up claims. Because what we don't do, folks, is we don't say, hey, you know what, you have to wait 2 or 3 years before you file a claim. No. If the client purchased this policy and the day after they got the policy, they were in a car accident and needed to file a claim, that's fine. They can file a claim at any point with this. So because of that, you know, our largest cost is obviously all of our compensation. So we can't just buy up claims and then pay out commissions and pretty nice commissions too, and you'll work with Shad and Premier on that, but we can't just do that and then just issue this on anybody. So that's why there's no annuity that complies with that tax law that allows for tax-free benefits for care. There's no annuity that has that without some form of underwriting. And our form of underwriting is no on these 5 questions. All right? So that's the base policy, folks. For those that are interested in looking at the rider, we'll have a quick look, but what I want to first do is pull up, let's look at the illustration here. I'm just going to go ahead and pull up the actual illustration itself because I have them right down here. So here's the illustration with no rider, okay? A lot of this stuff you're used to. This looks a lot awful like we actually took and we designed this kind of after income benefit riders on indexed annuities, so it looks very similar. This is all the jargon that you got to throw in there. Here's the little chart that talks about the multiplier that we looked at. Here's what really matters. These are the pages, of course, you're going to look at with your client. Number 1, the guaranteed basis. This assumes that, the S&P just never performs, that it's flat or negative. So you'll notice the account value stays $150,000. Okay, this is a 70-year-old female. However, look at her LTC benefit balance. This has that multiplier built in, so she's going to get her step up every year regardless of how her account value is performing. That's the worst case scenario. This is flat or negative S&P, okay? Or we'll take the last 10 years, and this will be our most recent. So what we do here, folks, we have a most recent, which is the last 10 years. This is, again, probably nothing new to you guys that sell index annuities. We have a low scenario where the S&P was at its lowest on that period, and then a high scenario. Keep in mind, that doesn't necessarily mean this was the most favorable period to be in an indexing product. That's just talking about the S&P performance itself, okay? So when we go back to our non-guaranteed, it assumes the last 10 years is what happened, and it just repeats itself every 10 years. So look at this now. Now she's really stepping up because we're giving her that account value multiplier. So we're multiplying her account value by that multiplier. Again, the client doesn't necessarily have to fully understand that. What they understand is this is a worst case step up. This is what would have happened over the last 10 years, okay? And this is my monthly benefit. That, again, if this was on a joint, folks, that would be each per person tax-free. So they're just depleting their pool of money twice as quickly, their annuity, which is a reason why so many of our joint policies tend to have a rider added onto them, okay? So that's the basic illustration right there. This will show you again, this was an annual point-to-point with the cap. I just chose one, real basic. That's what we've seen the most of so far. Because we've had this policy available, we just didn't have the illustration approved through the states. So right now, it is available everywhere that the policy itself is available. So it's everywhere but California and Hawaii, and we don't do business in New York, okay? So that's the base policy. That's what that illustration would look like. You have a sort of an overview page, which is just the base annuity here. If we had a rider, it would show here. If you don't add one, we don't want you to have to field questions that you're not talking about, so it just looks like this, all right? Now, the rider I mentioned, we can either take a bucket and we can take 150 and we can give them another bucket of 150 behind it. We could triple the money, so we give them another bucket of 300 behind it, or we can have lifetime coverage, and they get into that. We call that a continuation of benefits. They get into that rider after they've depleted their own annuity. So let me see if, yeah, let's go back to the rider page. I just want to give everybody a visual of that again because I think it makes it a little easier. Here we go. Okay, so here's your rider options. Now, the rider can be paid in full in a lump sum, or it could be paid again as a fixed ongoing annual premium. There's a couple of reasons why you might do one or the other. Number one, if it was an incoming annuity with gain, non-qualified, you could actually tell us to include the rider lump sum cost. So maybe out of the $150,000, maybe $40,000 pays for the lifetime rider, and the other $110,000 pays for goes into the index annuity. So the downside is you've taken 40 grand out already, and you've purchased that rider. The upside is there's no more ongoing premium; it's just one and done. And also that rider, even though those dollars came out of that annuity as a withdrawal, right, which normally would be LIFO, because that withdrawal turned around and paid for an extension of benefits long-term care rider, it complies with the Pension Protection Act and is a tax-free event. So that's one of the reasons people like to do it. So if you or your client just want to one-shot it and done, then that's not a bad option. By far, the vast majority of the people we see with our policies tend to pay that rider as a separate ongoing premium. So they'll put the $150 into the annuity, and then they'll pay their ongoing premium that's fixed and guaranteed. That could be tax deductible or paid with an HSA because it's just an LTC rider behind the indexed policy. So if you want to take a look at what that looks like, here's the same 70-year-old female. All these pages are going to look identical because this is her base policy, okay? And then what I did was I ran 25% into each strategy. So now you have a few more pages because you have the point-to-point with the cap up top here, the point-to-point with the par, the monthly average with the cap, and the monthly average with the par, okay? And here's the main page that'll look different. So she has her base annuity, which she would deplete at $6,313 initially per month. That steps up, as we saw on that, each year based on either the multiplier or the account value, okay? And then after this has been depleted over the course of 2 years, she has another bucket of money here. So she's basically taken $150 and turned it into about $450,000. In other words, she'll use her first 24 months, and then we give her another 48 months. So her total with the rider, it turns her $150 into a pool of over $450,000 right away at $63.13 a month. And what I did here, folks, is I actually added a 2% compounding inflationary roll-up on her rider, because the base annuity, we know this is going to continue to grow one way or another, right? Either through that multiplier or through the account value or both. So this is going to continue to go up. We kind of want this rider payout. What we don't want is for her to have 24 months of a payout at whatever it might be, and at the time she files claim, then all of a sudden drop down to $6,313. So I wanted this thing to kind of roll up. So this cost for her, guys, she's 70 years old. Remember that this is giving her 72 months of coverage, assuming she's pulling the full benefit. If she doesn't need the full benefit, it just simply lasts longer, okay? But this is $4,310 a year, fixed and guaranteed to never increase. You can pull that from some other income stream you have. That could be RMDs from a qualified account that she's got to take anyways. And when she pays that premium each year, that ensures she has this bucket of $454, which is composed of her own money plus our leverage, and it's all tax-free. And this kind of gives you and your client, in this instance, the visual. Here's her $150 plus our $303, equaling the total pool of money. 2 years plus our 4 years of coverage, 6 years total. Pretty simple stuff in all actuality. If you can sell an income benefit, an income rider, some of those get kind of crazy. This is pretty simple stuff. It's just a little bit of a learning curve for you. But again, folks, this will give you the reason to move dollars. And speaking of moving dollars, we also have a thing called a transfer annuity. So here's how the transfer annuity works. The transfer annuity would be a situation where, let's see, I'll just go right here. I think we have. Look at the bottom here on this page. I'll just go from current slide. Here's what the transfer annuity is. So there are roughly half the companies out there that allow for partial 1035s and half that don't, right? And so let's take an example. Let's say the client has a $300,000 annuity at XYZ company, right? And they want some of that for income, and you want to help them with some income, but they feel maybe they could reposition, let's say 50% of that, 150,000 with us. Problem is, XYZ company won't allow for a partial withdrawal. So what you can do is you can actually fill out our paperwork and then fill out a form called a transfer annuity form. It's just a one-page form. And then you can place the other 150,000, let's say, with some other company to create income stream. So what we will do, folks, is we'll request the full $300,000 with our transfer annuity form. It looks to that company like we're going to make a full request, and we do, and all $300,000 comes over to us. It sits in that transfer annuity. We call it legacy care. You don't really have to concern yourself with it. It sits there for a day, and then the next day we take $150,000, we put it into our indexed annuity care, and we send the other $150,000 off along with your paperwork to the company that you want us to send it to, where you're going to create some income benefit. So it's a way for us to get around partial withdrawals. So a couple of unique things besides the product itself, right, is that we can take a singly owned contract and make it a joint for care as long as it's a spouse. And number two, we have a way to get around a company that doesn't allow for a partial withdrawal. So I'll go ahead, and I think I can see questions too, right, Chad? I don't know. No, it looks like you might have the questions. I don't know. Do you see any there, Chad?
Yeah, I do. I have a few questions here that we need to discuss. I know there were a couple questions here in reference to using qualified funds.
Yep. Okay, so qualified funds, you know, obviously in a perfect world, the non-qualified it's the lowest hanging fruit because you get that added bonus of tax-free withdrawals for care. But we know there's a lot of people out there that are heavily weighted in qualified accounts, and thus that's why the question comes up. So the way that you look at the qualified is there's still two features to this that they can't get anywhere else that could give you the reason. So you lose the fact that it's tax-free. Qualified dollars, unfortunately, are still taxable regardless of how they're used, right? Uncle Sam wants his taxes on the money. He's never had taxes. So only non-qualified gets the tax benefits. However, qualified, I still get that multiplier, so I still get the added benefit if this becomes my care plan of having some guaranteed leverage. And I still have the ability to purchase a rider, again, for double, triple, or lifetime at a super cheap fixed premium. So if I'm heavily weighted in qualified assets, even though it may not be tax-free, this is allowing me, you know, think about it this way. Think about an 85-year-old female. She's widowed. If you can take $150,000 and then right behind it make another pool of $150,000 for, at her age, let's call it $4,000 a year, she had no idea that she was even eligible to get extended care coverage or a pool of money that beyond her own for care. So even though it may be taxable, if I can pay $4,000 a year at age 85 to instantly have another bucket of $150 behind my own money, plus this multiplier built in, that could still be a very good story to tell. But obviously, when you start this thing, your lowest hanging fruit is your non-qualified dollars, specifically old non-qualified annuities with substantial gain. Great question.
Absolutely. I know there's a question here as well about the compensation on it. For that, I just say call us here at Premier, speak with the marketer you work with typically on there, and we can discuss the commission levels with you on that. And then there's a question on here, Jeremy, about the rider cost. And is it based upon the contract or the account value?
Great question. So the rider cost, is it based on, here's what the rider cost is based on. It's two things. Number one, it's going to be based on age. The older you are, the more expensive the rider would be, of course, because you're closer to potentially needing the care. So one is age. Another one is it single or joint? A rider will be more expensive on two individuals than on one because we have risk on two individuals needing care. And remember, even if they need care at the same time, we allow them to each pull the full monthly benefit, which would mean they'd get into the rider quicker. So age is one, single or joint is another, and then finally, the rider that you actually are going to add. Is it an additional 24 months? Is it additional 48 months or lifetime? So double, triple, or lifetime. Okay, so obviously triple is going to be more than double, and lifetime is going to be more than triple. In this example, I showed you the middle bucket, so I showed you not the doubling, I showed you the tripling of the money. So her 150 turned, we gave her another bucket of over 300, right? Her 151 turned to 300, 303. So that would cost her about $4,300 a year, right? So also I added that 2% compounding inflation because remember I wanted that rider portion to grow too. If I would have not chosen inflation, I'm fine with that 4 years of coverage that we give after hers not growing, just staying at $6,300 a month. That may have dropped down to say, you know, $2,800 a year. So again, you know, it's all about age, single or joint, And what rider am I going to add, and does that rider have any compounding inflation added onto it? The reason I chose 2%, folks, is because, you know, I think if you're trying to just average out what you think their gain would be over time, you know, right now, like I said, let's just say an annual point to point, it's 3.5%, right? If we can net somewhere around 2%, right, throughout this time, that's not bad that it's stepping up that way. Plus, we have the multiplier. So I like having that rider also grow at 2 or 3, and I think a lot of agents like that. But, you know, it may just be when you're on the phone with a marketer or Premier, before they run you an illustration, until you kind of learn these and learn where it fits best for you and your clients, you may say, well, what would that cost with 2%, or what would that be with 0? And actually, the illustration will show you here on this next page, or 2 pages later. So here's my lump sum cost, guaranteed single premium. Here's my annual. So here's the 4,300, okay? 4,310 for that additional 48 months with 2% inflation. I was actually pretty close what I told you there. I said about 2,800. Actually, if you didn't add inflation, it would only be 2,636. So these are some options. We actually allow for inflations between 2 up to 5%. So 2, 3, 4, 5, and 0, of course. So it just gives a snapshot here, but it kind of gives you an idea. So hopefully that answers the question. Long way around, but you know, there's a couple variables that really dictate the cost of that rider. But remember, that rider is fixed and guaranteed, non-cancelable, and can never be increased on the client. And when they file claim on the base, they still have to pay for the rider until they've depleted the annuity, and they fall on claim on the rider. If one or both is on claim on the rider, those premiums are automatically waived while they're on claim.
Okay, we will move on to the next question here then. This one, it says, have a client with a life contract with $70,000, would like to 1035 exchange it for both he and his wife. Yep. Average age is 53. How can we do it with your contract to get them both on the policy and eligible for benefits? I understand that I can't go from the individual life to a joint life with you guys, but how do we set that up?
Yeah, so here's how that sets up. And that makes another good point, guys. We know you can't go annuity to life, but you can go life to annuity, as this agent is very well aware. So the problem is it's an individually owned life policy. So first and foremost, it probably goes without saying that either that life policy is either imploding, or the death benefit is no longer concerned the client. The concern is care, which obviously that happens to a lot of people, right? As they age, the kids are grown, they're doing fine. We're not as concerned. The house is paid off. We're not as concerned about the death benefit. So let's move this over into this annuity. So here's how that would exactly work. So we would do a 1035 from their cash value of the life policy. I think, Chad, it was the husband was the owner, correct?
Let me go back up and take a look.
We can just say for this purpose it is, but I'm pretty sure that's what the husband's life policy, I believe.
For both him and his wife, average age 53, yeah.
But it's his life policy that we're doing that's individually owned. So what we do a 1035 of the 70,000. When you work with Premier on the paperwork, which we do have online and IGO e-apps, and I know that, you know, again, work with Premier, but I know that they've got that. So basically what you can do is on the actual application, the husband will be the owner, the wife will be the primary beneficiary, and then there's a unique line on the app called an eligible person for care. And that's where you would also put the wife. So as we know, a spouse can continue the contract without being forced to annuitize or have periodic payments or out in 5. So even if he passed away 15 years later and never needed care or needed some, she, because she's the primary beneficiary, becomes the owner through spousal continuation and would just continue this contract. So that's all. It's that simple. So we're not actually, quote unquote, making her a joint owner per se, but for your clients, it works just like a joint policy, because if either needs care, they get the full monthly benefit each, and if the owner passes, the surviving spouse continues the contract. So does that make sense, Chad?
Yes, absolutely. Let's see, we'll go on to the next question here. I guess one question was, what was the rider called again? I mean, it just depends upon, I guess it's the continuation of benefits rider.
Yeah, exactly. So what we call the COB rider, continuation benefits, and again, when it shows on the illustration, it'll say COB, continuation of benefits.
Absolutely.
Here,
then what
LTC coverage behind the annuity at a super cheap and fixed cost, because the client, it's kind of like a high deductible. you know. That's an easy way to explain to your client. Almost everybody, you know, had health insurance when they worked and understood that if you wanted the blue plan as opposed to the red, your premiums were cheaper. It's because you had to pay a higher deductible up front. And that's kind of what this is. We have fixed premiums that are guaranteed, and they're cheap considering what you get, because you've got to use your own money first, so it protects us a little more on the front end.
Absolutely, and guaranteed to never increase on those premiums as well.
Guaranteed, non-cancelable, can never ever increase. You will never have to sit down with your client and say, One America sent you a 30% rate increase on your COB rider premiums.
That is huge. We will move on then. What happens if the beneficiary dies before the use of any benefits paid out, or only 1 year paid out?
Yeah, so if the beneficiary dies or the owners? The beneficiary?
This says beneficiary.
Okay, I'll talk about both situations just to make sure. Number one, if the beneficiary dies, you probably want to make sure you have contingent beneficiaries, right? Like any other annuity or income benefit.
Correct.
And I think what the question might have really been was, what happens if the owners die, owner or owners die, and only portion of the annuity was used for care? They haven't used it all. Well, just like any other annuity, the account value, right, is what would pass on. So in other words, if we go, let's go to a worst case scenario. This is guaranteed. So again, the S&P never performs. So the account value is only $150,000. Let's say he passes in his sleep, never needs care, like we all wish we would, but it's very rare. She needs care for a little while. She uses $50,000. Well, that's $150,000 minus the $50,000 in care benefits. So there would still be $100,000 left to pass to the heirs. And you know, if there's gain in that annuity, they're going to need to pay taxes on it. So most people would stretch it or whatever. But it's just easiest, simplest way to think of it. It's just like the client took a dollar for dollar withdrawal of the cash value on any other annuity. Whatever's left passes to the heirs. So again, if you don't use it all, you don't lose it all. And it would be taxable to the heirs at their current income tax bracket, like any other non-qualified annuity or qualified account, of course.
Perfect. Okay, then the next question is, can you lose any amount that you've invested? And you know, if that's going to be just like any other index annuity, due to the market conditions, no. I mean, the only way you can lose any of your money is if you reach in and take anything out, whether it's free withdrawals or based on claim.
Exactly. Yep. So the cash surrender column in the middle of the page there, like any other index annuity, that's the only thing. That's the only risk of losing, is if you walk with that. Now, remember I said after the first year there's 10% free withdrawals, like you are so accustomed to with other annuities, 10 or 15%. If I take 10% of my cash value, then I'm reducing my LTC balance and my monthly benefit by 10%. So you are not able to go into this annuity, withdraw 90% of the cash value, and still have a big chunk left for care. You know, insurance companies caught on to that with life insurance back in the day, and they've gone down to a pro rata versus dollar for dollar. So if I take any proportion of one, it reduces the others proportionately.
Absolutely. Next question is, are there any marketing pieces to get to a cold market? I'm assuming that you're talking about cold calls here. And yes, One America has a lot of different marketing pieces that we can get out to you. Just make sure you speak with your marketing representative here at Premier, and we'll be happy to get those out to you. And then the state availability, Jeremy, is it approved in Pennsylvania or in New Jersey?
It is in both places. Yep. It is everywhere but California and Hawaii. And then we don't do any business in New York. So let's see here. I should have it. There you go. Now, that being said, just a good note, if you happen to have clients in New York or California or Hawaii, or any other state for that matter, the One America stance is that, you know, back in the day, you used to be able to just cross a state line and sign the paper. We can't allow that anymore. They've kind of tightened on us on that. But what we can allow for is if I live in New York, for example, but I have a house, a summer home in New Jersey, right? As long as I have a physical address, it doesn't have to be where I pay my taxes, and it doesn't have to be my primary residency, but as long as I have a physical residence in another state, I can write this on that state's paper, assuming the agent, of course, is licensed properly to write in that state, and of course Premier is, which, Shad, correct me if I'm wrong, I think you guys are licensed in close to all 50 states, if not all 50.
Yeah. Yes,
so,
we are.
Yep. So, yeah, absolutely. New Jersey and Pennsylvania, have at it.
Very good. And then we have a question on whether if we can send the PowerPoint presentation to the attendees, and of course we can do that. And we are recording this as well, so if you would like a recorded version of it as well, I mean, please reach out to your marketers here, and we will be more than happy to provide that for you as well. Then we can move on to the other questions here. On the other One America products, you allow joint with other spouse as long as your insurable interest, but on the index annuity, it's only spouse?
That's a great question. Somebody definitely knows our solutions there. Yeah, on the annuity-based policies, it's spouse only. And the reason is it's an IRS deal, because an IRS deal, when you own the annuity, well, I should say you could enter into a joint annuity with somebody else, but if the annuity coming over is individually owned, we can only add a spouse to something that's already individually owned, because only a spouse could continue the contract through spousal continuation and not be forced to start a periodic payment out. So, you know, it's just part of the IRS problem. I mean, we wouldn't care, but it would kind of defeat the purpose. If I'm the individual owner and I had my sister and then I die, she's got to have that annuity liquidated within 5 years, out in 5, or set up on an annuitization, which would kill the whole care benefit and just wouldn't make sense. So hopefully that clarifies that question. You could still enter into a joint contract, you know, as long as you were joint owners, but if it's individually owned already, we can only add a spouse.
Perfect. Then we have a question on here, is that a one-time additional premium for the rider?
You can choose. So on this particular page, we said it was about $4,000 a year, right here, $4,310 a year, fixed and guaranteed for her to have $150,000 instantly turned over $450. You can see here that instead of paying $4,375.73, she could knock this all out, or I'm sorry, $4,310. She could knock it all out by just paying that up in full at $50,000. But you probably want to do a little calculation, break-even point. If I just take 752 and I divide it by 4,310, it's just shy of 12 years that it would take me before I paid 50,000 in. So that would put her around 82. So obviously, you know, different strokes for different folks. Some people are going to want to pay it up in full. Others are going to say, well, you know, I like the idea that I can potentially deduct this rider premium like a long-term care insurance premium, because the IRS considers it the same, because it's a premium that's not going into my cash value or annuity. It's a premium that's paying for pure LTCI coverage. So what I would generally say is that client would want to work with their tax advisor, most likely their CPA, to figure out which route might be better for them. But we offer either.
Perfect. Next question we have here then is, even though qualified money is not able to be treated tax-free when coming out for a long-term care, is there any other reason why this can't be an option for IRAs or in a 401k, particularly in small business owners?
Not at all. I mean, you know, here's the thing. Will it be taxable? Yes. But let's think about it this way. So if they put $150,000 in this annuity, and let's just say they need care next year, and it's IRA dollars, and it pays out $6,000 a month. $6,000 a month, right, times 12, what is that, 66, 72? If that exceeds 7.5 or 10% of their adjusted gross income, then they could turn around and meet that medical expense deduction. So although it may come out taxable, if they're pulling enough out to comply with that part of the tax law, it may be a wash. Does that make sense, Chad? Am I making sense there? You know, because although it comes out fully taxable, if they're pulling $6,300 a month, right, which is what this would be right off the bat, $6,313. So $6,313 times 12, that's $75,000, almost $76,000 a year. So if that exceeds, which for a lot of people, of course it would, you know, depending on your age, 7.5 to 10% AGI, then you could actually turn around and deduct that as a medical expense.
Absolutely. So yeah, it could be a very viable option for that as well.
And again, folks, you know, of course I'm biased here, but in my mind, if I'm thinking about my family, what are we really buying here? Well, that multiplier is nice, but since we're taking the tax benefit out of it, what we're really doing is buying that rider behind the IRA at a super cheap cost. So we're using the IRA as kind of our all-in in order to purchase care coverage that we never knew we could get on my grandmother who was 85 or my mom who was 76, right? So.
Well, absolutely. I think once again, guaranteed to never have that premium go up.
Everything is fixed and guaranteed here. Yeah, you show that client that guaranteed page and it can never show any different, assuming they don't take withdrawals, of course, from their cash value.
Absolutely. Okay, we have a couple more here, I believe. Can my HSA buy this? Or I think you said you pay for the lifetime rider.
Say that one more time, Shed. Can I save age?
No, can the HSA purchase it? But then it says that you mentioned that you can do it for the lifetime rider.
So you can. So the HSA can't purchase the annuity itself. Number one, you can't use the HSA to purchase, of course, because it holds cash value and tax deferral and all that. Also, we don't allow for flexible premium. It's lump sum only on the annuity. But the rider, that's why a lot of people like to pay that on an ongoing premium, especially if they have an HSA, because the rider premium, again, is considered HIPAA qualified. IRS considers it LTCI premium. So yes, my HSA, I could fund my HSA each year, which I think I funded my max mine this year, and it was like 6,700 or something. So as you know, you can only max up to what you can go. But in this client's instance, her rider was 4,300 a month or a year. I'm sorry. She could fund her HSA each year and take 43 and pay for the rider. And so it was tax-free under HSA and tax-free to pay for the rider.
Absolutely, it works out perfect for that to partner those up with that. Must the eligible person for care medically qualify?
Yes, and again, they need to at least say no to those 5 knockout questions on the app, because remember, we don't want to buy up claims. So that's a great question, and I'd say it's a question I get almost asked all the time, and I'm sure you do, Shad, you and your marketing team all the time. You know, on a joint, can one not be insurable? Unfortunately, because we give them full benefits, remember that monthly benefit of $6,300, if this was a joint, would be available to each of them, even if they needed it at the same time. So it's just too much risk for us to purchase, or for allow one client who's not insurable to purchase it. So, you know, we do have a pre-screen form. So if you're going to add a rider, you know, you can add it. But the 10-minute phone interview, folks, just so you know, it's mostly cognitive testing. It's what day is it, who's the president, you know, what's the similarity between an apple and an orange. It's about a 10-minute phone interview per person, mostly cognitive. And that is only required if we're going to add a rider. If there's no rider, then that spouse that has some health issues just needs to say no to those 5 questions. We do pull a medical information bureau report. So before we issue the contract or request a 1035, we make sure that we don't see a code on there that the client is actually on oxygen, even though they said they weren't on the app. So it's a checks and balances things for us. So definitely encourage your clients to know that we will check in online, you know, where their doctors report stuff too. We're not pulling records, and we're not asking for exams. It just takes us, the underwriter, just a couple minutes to pull this central agency where they report what they've prescribed to the client, so that we know that, you know, there's nothing that they're telling us that actually is false.
Okay, then we have a couple more questions here. Are there any restrictions in Maryland, Pennsylvania, DC, or Virginia?
No, not as far as product and illustration goes, no.
Okay.
This was approved. One of the beautiful things we have too is we have a thing called a compact now, for those of you that don't know, and I think it consists of about 38 states. I'm not sure if those states are in there, I don't recall. But the compact now is one committee, and if they approve it, it gets automatically approved in 38 states. So this was, out of all the products we've ever released, this was by far the largest approval rate that we've had. 47 of the 49 states we applied in have approved it thus far.
Fantastic. Can this program work with special needs children, special needs trust?
No, we can't insure. I believe that's one of the things we wouldn't insure, is like a, you know, if the children had some, like, you know, Down syndrome or something. Unfortunately, that would be a knockout.
Okay. Do you have an immediate annuity that could fund the annual premium and even on a 1035?
Absolutely do. Yeah, we have an immediate annuity that is just a run-of-the-mill annuity, and we can calculate. You can work with Premier, and they can work with with us closely, and we can calculate the dollar amount that would go into the immediate annuity, and then we can use that. We would give you the exact figure that we need to go to pay that annual rider. Now, the one thing that would change is when the client's on claim, that rider premium is no longer due. So we would redirect that payout from the SPIA back to the client. But during all those years they were paying the rider, we would just basically move it from their SPIA with us to pay their rider with us.
And Jeremy, I know you've illustrated here today on a single pay and then like basically a life pay for that. But do you short pay for the COBR like you do with your other products, like a 10 pay or 20 pay?
That's a good question. Let's go to, I believe we do, but let me see if this will let me go back here. This is our online illustration that you're very familiar with. Let's see here. No, this one, it looks like just continuous or single.
Okay.
Yep.
Okay. And then the very last question I believe we have right now is, says, in California, when the National Agent Registry becomes the law of the land, will it be able to sell a resident of another state but not still in my own state?
That's a good question. I can't tell you I know the answer to that right now. I'll look into that, see if I can't get it for you, Shad, but I do not know the answer to that right now. Okay. That's a great question. If you want to just maybe shoot me an email with that question, I'll send it up to our advanced team and see if they've figured that out yet.
Okay, yeah, I'll write that down and email that on over to you after the call's done. And we did have one final one come through. Does a state annuity premium tax come into play anywhere?
Not assuming obviously this is used for care. If it's going to be transferred on, I would just say you'd have to work with the tax advisor on that.
Okay.
Yeah. For care, no. I mean, for care benefits, this is, again, HIPAA qualified. So the HIPAA law from 1996 is what governs this annuity to be paid out as a care benefit. It's allowed to be marketed as a care benefit, and it's allowed to have that rider as a care benefit. And then the Pension Protection Act of 2010 amended the HIPAA to include annuities, because the HIPAA was initially just, long-term care insurance and life with long-term care benefits. So, from a care perspective, that's absolutely not going to be an issue here. But if it's passing on, again, work with the tax advisor.
Perfect. Well, and I believe that is all the questions that we have here today on this. And I guess once again, I want to thank you, Jeremy, and then everyone else here on the call, and to take time out of your busy day. I know we've made some comments here to give your marketer here at Premier a call. In case you do not have that number handy, it is 1-800-365-8208. And any of your marketers here should be able to help you out on that. Jeremy, did you have any final closing comments you wanted to make?
No, that's it. We also have a client-approved PowerPoint. We're starting to work on some stuff that's more client-facing material itself, and we have a brochure, of course, and all that. But just keep the eye open. I'm sure that, as Premier gets this stuff from me, they'll absolutely make you aware of it. But right now, I mean, this thing is good to go, and we appreciate any of your business. So appreciate the time, Shad. Thank you to you and the staff of Premier, and we'll make sure you have everything to distribute to these folks.
Sounds good. Thank you very much. And I guess we did have one final question about the PowerPoint. Once again, you can give us a call here, or we'll be sending some out as well. But you can give your marketer a call here. We'll be able to give you a copy of the replay on this, and then also the PowerPoint presentation as well. So with that, we will call it a day. It looks like we're right at an hour, so that works out perfect. Happy selling, everyone, and good luck. Thank you.